Hello, fellow Rebel Capitals. Hope you're well. Got a big announcement this week from Fed Chair Jerome Powell. Like I said in the title, this could change everything. And I'm not being hyperbolic there. If he raises interest rates, I think there are unintended consequences that we could see that take us back to maybe an environment like we saw in March of 2020, or potentially what we saw during the GFC, or maybe pulling back and looking at the bigger picture. If you look at it through the lens of my conversation yesterday with Joseph Wang, it could take us back to 1972 to 1974. And if you guys don't recall, that's where we had significant rates of inflation, but the stock market went down by 50% in nominal terms. So let me kind of go over those ideas on how a rate hike, well, let's go over the article first, and then we'll discuss how a rate hike could take us to this a stock market crash, which is basically what I'm referring to about March, or maybe a bigger recession like we saw during the GFC, or maybe an inflationary recession that's coupled with a stock market crash like we saw at the beginning of the 1970s. Let's dive into the article here from CNBC. The Fed is expected to announce end to bond buying program as investors seek clues on first rate hike. Key points. On Wednesday, the Federal Reserve is expected to announce it will start unwinding its $120 billion a month bond purchase. Is unwinding, I don't know if that's the right word. It implies that they're doing quantitative tightening, and they're by no means doing that. They're simply, you know what this is like? It's similar to the differentiation between deflation and disinflation. It's like they're saying the Fed will start to deflate by 120 billion. Not really. It's just disinflation. It's not like we're going from prices going up to prices going down. We're just talking about prices going up a little bit less. So I don't know. I would say reduce its 120 billion monthly bond purchases, a program it started to support economic during the, well, what? Come on, CNBC. A program it started to support the economy during the cerveza sickness. What are you talking about? It was started back in 2008 by Ben Bernanke. Remember, it was supposed to be a temporary program. Nothing to see here. Don't worry about it. We're just doing this new thing called quantitative easing, and we're just doing it because we've got some, we've got to take extreme measures because we're going through this unprecedented recession and housing market crash, and we've got to make sure we don't have any systemic risk. So we're just going to, just for the time being, don't have to worry about this, guys. This is not monetizing the debt. Remember what Ben Bernanke said. And the reason he said it wasn't monetizing the debt is because he said he was going to unwind the balance sheet. And therefore, if you're just buying those treasuries or mortgage-backed securities temporarily, then by his definition, well, it wasn't monetizing the debt. Well, how temporary were those bond purchases? How temporary was that quantitative easing? We look at it now, and that was 12, 13 years ago. And the balance sheet of the Fed is not where it was in 2008, which was 800 billion. It's now at over 8 trillion. So this quantitative easing was not only temporary, it was a complete opposite of that. In fact, it was even worse because the opposite of that would be permanent. But that would imply that they just maintained a high level or a higher level than 800 billion. They've been increasing it. So it's getting exponentially worse as the years go on. And this is why you always go back and use the term, it's a monetary heroin. That's all this is. And once you get the economy addicted to the drug, you need more and more of that drug to have the same effect. And we've gone from quantitative easing to now we've got deficit spending. We talk about that on these videos all the time. But let's be clear, this was not a program that was just started in March of 2020. This was a quote unquote temporary program that was started way back in 2008 by Ben Bernanke. Fed Chair Powell is likely to stress the end of the bond buying is likely to stress the end of the bond program and the start of rate hikes are not connected. Oh, I see what they're saying. Okay. So Fed Chair Powell is likely to stress that the end of the bond buying program and the start of rate hikes aren't necessarily synonymous. So what this means is although we might stop buying bonds, number one, that doesn't mean that we're going to reduce the size of our balance sheet. We're just reducing the amount we're purchasing. And this in no way implies that even if we stop buying bonds, that after that we will increase interest rates. So he's really kind of hedging his bets because remember, the only tool the Fed has that actually has an impact is expectations policy because their balance sheet really doesn't directly affect the stock market, as an example. Now, if you look at charts, it seems like they're directly correlated. They're going up or down almost in lockstep. But it's more of a psychological ploy that the Fed has where it's this Pavlovian response that the market has incorporated over many years of conditioning. So now when the Fed comes out and says they're increasing the size of their balance sheet, well, now the stock market goes up, but it's not because that there's a direct relationship between the size of the Fed's balance sheet and the liquidity going into the stock market without the help of the commercial banks. Now you can say, well, George, it expands their balance sheet capacity. They lend to hedge funds, and then the hedge funds go in and drive up the stock market. That may be true, but that's the Fed needs a third party in order to make that happen. It doesn't happen automatically just because they increase the size of their balance sheet. That's the bottom line. Powell's comments on inflation could be the most important message from the Fed, since that may help investors get a sense of the central bank's thinking around interest rate policy. I don't know why, because we go back to the Pavlovian response. How many times does the Fed have to lie? I mean, honestly, here it goes back to this thing that we see in society with this belief that a lot of people have, or this trust a lot of people have in the institutions and the politicians, that when you kind of step back and look at it for what it is, it's just this Stockholm syndrome where they have this bizarre, weird emotional attachment to the people that are treating them poorly. The kidnapper, if you will. So in this case, the market is just waiting on edge to hear what Jerome Powell has to say about inflation, assuming that if inflation gets too high, well, the Fed is going to have to come in and do something. They're going to have to come in and start raising interest rates, assuming that they're not buying any more bonds. Well, why are you making that assumption? You're taking the Fed at their word. Why? What would lead you to believe that the Fed will keep their word? What would lead you to believe that an entity that has on several occasions completely ignored the laws that are supposed to constrain it, meaning the Federal Reserve Act, why on earth would you believe that they're going to abide by their mandate moving forward? I mean, another way I'd ask that is what has the Federal Reserve done in the last 2 decades that would make you trust them? Answer for me is zero. They've done the exact opposite. In fact, meaning everything that they've done makes me not trust them. And it's the same thing with the central planners, the politicians, and the people that are in charge of our institutions. That's why when I look at things, all I see is Stockholm syndrome. Let's keep going. This week, the Fed is widely expected to announce unwinding of its monthly bond buying, a measure it started. Again, they make this. Okay. However, the bigger story is the bigger story for markets is how central bank will discuss inflation. And why the market cares, I don't know. I think what makes a bigger impact for me is just when I go down to the grocery store and I'm paying triple what I paid 6 months ago or a year ago or back in 2019. What makes a big impact for me is when I go to every single store in a strip mall and they all have help wanted signs. Uh, or when I go to the grocery store and 10% of the shelves are completely barren. That for me means a lot more than anything that comes out of the mouth of Jerome Powell. Economists expect the central bank to say after its 2-day meeting concludes Wednesday that it'll begin winding down its 120. Okay, we talked about that. And the time frame they're giving is mid-November or December and end the program entirely by the middle of next year. I'd say question mark, question mark, question mark, because we know that their biggest priority is not fighting inflation. It's not the unemployment rate. It's definitely not maintaining the value of the dollar. That's for sure. Their number one priority, although they won't admit it, is just keeping the stock market propped up. So if they start to reduce the QE and the market falls out of bed, well, I can almost guarantee you they're not going to get back down to zero purchases. They're going to go right back up to 120 billion. And my guess is they would have to do even more because, again, we've got to look at quantitative easing as though it's heroin. You see, we're taking away that heroin. Is the addict going to go through withdrawals? Most likely. So when you give the heroin back to the addict, they're going to require an even larger dose to be quote unquote normal. And I think it's the exact same thing with quantitative easing and the stock market right now. Fed Chair Powell has made an effort to emphasize the end of the program does not signal the start of new rate hike cycle. So here's where he has to walk this balancing act, right? So let's think this through for a moment. If the Fed's balance sheet was all powerful, so they knew that if they increased the size of their balance sheet by doing quantitative easing, that there would be a causal component with the stock market, or there would be a causal relationship where the increase in the balance sheet would directly create more liquidity or capital funneling into the stock market. Therefore, the stock market would have to go up if the Fed increased their QE. If that was true, which is what the market actually believes, then why on earth does Powell or Yellen or Bernanke have to tiptoe around everything? They're always tap dancing around the subject, and they're always trying to create this illusion of this Goldilocks type of economy or this Goldilocks type of monetary policy where they've just got it perfect. It's not too hot, it's not too cold. And then he's saying, well, just make sure that you don't confuse reducing the size of quantitative easing with also jacking interest rates. Why is he so adamant that the market knows that? If he can control the stock market just through his balance sheet, just by waving the magic wand, then what does he care what the market thinks? What does he care about his messaging? What does he care about expectations policy? You see, the simple fact that the Fed chairs always are tap dancing around every subject. They're always kind of walking on eggshells, and they're always trying to present things as though, oh, don't worry, we got this covered. Not too hot, not too cold. Just whatever you do, don't sell your stocks. That's when you look at whatever the Fed chairs say. That's really how you can summarize everything. Not too hot, not too cold. Whatever you do, don't sell stocks. But you see my point is if they did control, if the central banks were central, like Snyder says, they wouldn't need expectations policy. That's my point. But already traders are pricing in more than 2 interest rate hikes for next year. So the Fed is saying, oh, no. Nothing to see here. We're definitely not raising rates. In other words, don't sell your stocks. But the market is saying, well, they'll most likely increase rates. Now, I don't think they'll get to that point because I think the stock market would collapse prior to then. But you never know. It's just a game of probabilities. So we will have to see. Now, the one thing I would remind you, and if you guys watched the video yesterday with Joseph Wang, you'll probably uh, you probably understand this better, is that he presents a very strong case for the Fed increasing interest rates and that actually causing more inflation because the system is far different today than it was prior to the GFC. See, during the GFC or prior to the GFC, we had much more of a free market with banking and what created the Fed funds rate. So the banks would lend to each other overnight in these money markets. Well, what happened when the Fed came in and just unleashed this tidal wave of bank reserves through quantitative easing, then the banks really didn't need to lend each other. They didn't really need to borrow that much. And they definitely didn't need consumer deposits. They were flushed with reserves. That's why Bernanke came in and had to institute interest on reserves, or IOR, or back then it was IOER, interest on excess reserves. Because if he wouldn't have done that, the natural rate would have never got above zero, and the Fed could not have raised it because there was so much liquidity in the system that the banks would, in fact, rates might have even gone negative. That's a whole different rabbit hole there. So Bernanke came in and said, okay, we have to pay the banks to hold their reserves with the Fed. And that's how we will keep rates above zero if that's what we so choose. And that's when they went to kind of this 25 basis point range that we see now. But my point is the system was far, far different back then. So now Joseph Wang, his hypothesis or his theory is that if the Fed raises interest rates, that creates a bigger delta between the commercial bank's balance sheet and what they're paying in expenses for the liabilities in their balance sheet compared to what they're receiving as far as a yield for the assets on their balance sheet. Because before they would go up in lockstep when we had more of a free market. But now what they pay you basically for a checking account can remain at zero, even if the Fed jacks rates up to 2.5, 3, 4, 5%. So what does that mean? More profit for the banks. What do they do with that profit? They'll go in and buy treasuries. Well, if there is a debt ceiling, that means that Janet Yellen is issuing fewer treasuries. So where would the banks buy those treasuries? Off the balance sheets of the non-bank entities in the real economy. You guys watching this video, the average Joe and Jane. Okay. Well, if the bank buys an asset from a non-bank entity, it creates more dollars that did not exist before. It's just like lending. So if banks are buying these treasuries with their additional profits, that's creating more dollars circulating in the real economy, chasing goods and services. That's the gist of his theory. So my point is the Fed thinks, and the market thinks, and the talking heads and CNBC and Bloomberg, they all think that if the Fed raises rates, oh, well, fighting inflation. And maybe that was true prior to the GFC. But now, Mr. Bernanke and all the other Fed chairs since him have distorted and changed the plumbing for the entire financial system. So we could see some unintended consequences in the future that just hits the market and the central planners, that blindsides them, just comes straight out of right field. So then they go on and they ask these economists and guys that are chief investment officers, BlackRock. They're just getting hyper focused on the word transitory. They're betting that that's going to be left out of the vocabulary that Jerome Powell uses when he addresses the media. I mean, again, who cares? It's all smoke and mirrors. This is all smoke and mirrors BS. When you actually understand how the system works, you realize how frivolous this is. And it makes you look at the market and the so-called experts and just scratch your head and say, well, maybe the experts don't really know that much. And then this gentleman is saying that's the hottest job market since World War I. Yeah, I've been saying it's the hottest job market in American history. I don't know how we had a hotter job market in World War I. Maybe that's maybe I should say it's the hottest job market during non-war times in American history. And here we say that the Fed is just talking about reducing the size of their balance, or not even that. I'm making a mistake. Reducing their purchases by 10 billion a month with bonds and maybe 5 billion a month with mortgage-backed securities. I would ask why. I mean, if we don't have anything to worry about, if the economy is booming, if the economy is on fire, and that's why we have this inflation, because remember, that's what the mainstream economists think. They think that there's a direct relationship between inflation and how well the economy is doing. They completely forget about the 1970s when we had an inflationary recession. So we have inflation, but yet economic output goes down. So they're still, for whatever reason, ignoring the 1970s as though it didn't exist. It's kind of an inconvenient truth for Keynesian economists. So my argument for them would be, listen, if we got all this inflation, and that's directly representative of an economy that's on fire, that's booming, then why on earth are they just scaling back 15 billion? Why not just scale back 120 billion? Why keep doing it? In fact, why not just normalize interest rates? Why not take the balance sheet back down to 800 billion if the economy is doing so well? And if you ask that question to a mainstream economist, you'll probably get crickets, because there is no answer. Because if you just step back and look at what they're actually doing and completely ignore what they say and look at what they're doing, it makes it obvious as to how sick the real economy actually is. And here's where it says Powell is not likely to talk about raising interest rates. Why? Tap dancing around, because the central banks aren't central. And then Diane Swank, chief economist Grant Thornton, said she expects Fed will be forced to raise rates the next year. Again, how can these people continue to believe the Fed? They come out and contradict themselves. They lie. They can't predict anything. I mean, go back over the last 2 decades. What has the Fed predicted accurately? I mean, Jerome Powell was just coming out a few months ago saying it's transitory. Wrong. QE is temporary. Wrong. We're going to create inflation, or by the way they measure it. Remember when Bernanke and Yellen said that what their policies were going to do that? Wrong. They literally get every single thing wrong. They contradict themselves. They blatantly lie, but yet for some reason, people who are quote unquote experts continue to believe that they're going to try to fight inflation. It's staggering. What they're going to do is they're going to try to create financial repression. That's negative real interest rates. Why? Because they have to bail out the government. Plain and simple. And that's the only way that you can get debt to GDP from 130% down to, let's say, 60 or 70%, something that's more manageable, is by a default. And they're not going to default by not paying people, most likely. So they're going to default, as Schiff says, the dishonest way. And that's through trying to create inflation for a long period of time. They're just not telling you that. Okay, guys, enjoy the rest of your afternoon. Make sure that you're always standing up, fighting for freedom, liberty, and free market capitalism. And we'll see you in the next video.